Shocking turn. Ford cuts F-150 Lightning production. What's next? What happens when an automotive giant taps the brakes on its electric dream vehicle? Ford, the powerhouse behind the iconic F-150, has taken a surprising turn by slashing the production of its all-electric truck, the F-150 Lightning. This comes just as the electric vehicle market is heating up, with more drivers than ever looking to go electric. Is this a speed bump in Ford's electric journey, or a calculated shift in a high-stakes industry? We're about to take a deep dive into the story behind this unexpected move. As we peel back the layers of Ford's bold decision, you might be wondering, why would a company scale back its production on a product that's been a beacon of innovation and a symbol of the future? Well, it's not just about the trucks rolling off the line. It's about reading the road signs of the market. Let's take a closer look at what happened. During an all-earnings call in October, Ford's executives announced a significant strategic shift in their approach to electric vehicles. This wasn't a mere adjustment, but a substantial pivot in response to the evolving electric vehicle market. Originally, Ford's outlook for the F-150 Lightning was highly optimistic, marked by a staggering 200,000 reservations. This enthusiasm led to ambitious production targets of 3,200 trucks per week, aiming to hit an annual output of 150,000 units at the Rogue Electric Vehicle Center in Dearborn, Michigan. But here's where the trajectory changes. Despite their initial high expectations, Ford has decided to recalibrate its production targets. The automaker is now set to produce about 1,600 F-150 Lightning trucks weekly starting January 2024, effectively slashing the production by half from their original goal. This decision, revealed in a memo obtained by Automotive News, marks a significant revision from Ford's earlier projection of 3,200 vehicles assembled per week. So, what's driving this significant change in Ford's strategy? Stay with us as we uncover the factors influencing this major shift. Don't forget to like and subscribe for more updates on this unfolding story and the latest in the automotive world. One of the major reasons lies in the tale of supply and demand, influenced heavily by evolving consumer preferences and economic factors. Ford's own statement sheds light on their approach, emphasizing their intention to continue to match production to customer demand. This shift is a pragmatic response to a noticeable change in consumer behavior. Customers are increasingly cautious about the higher prices associated with electric vehicles, especially when compared to their gas-owned counterparts. For example, the starting price for the F-150 Lightning Pro is $49,995 before tax credits, a noticeable jump from the $40,780 starting price of a base XL Super Crew F-150 gas-powered truck. A noticeable jump from the $40,780 starting price of a base XL Super Crew F-150 gas-powered truck. This price difference, compounded by rising financing costs, has led to a cooling of consumer enthusiasm for higher-priced EVs. Ford CEO Jim Farley has pinpointed inadequate charging infrastructure as a major obstacle in the electric vehicle market. The number of electric cars in the U.S. has surged 87.5%, from 543,610 units to 1 million. However, the expansion of public charging points has not matched this pace, growing only about 31%, from 98,422 to 128,554. This disparity highlights a significant gap in infrastructure growth compared to the rapidly increasing number of electric vehicles. Moreover, Ford's recent decision to reduce its F-150 Lightning production also reflects broader industry trends and internal financial realities. The electrical vehicle adoption rate has seen a slowdown, a development that's leading many automakers, Ford included, to rethink their EV investment strategies. Adding a financial dimension to this picture, Ford's Q3 2023 earnings report sheds light on some of the challenges faced by its Model E electric vehicle unit. The division reported a significant operating loss of $1.3 billion in the third quarter, doubling its loss from 2022. The losses for the first three quarters amounted to $3.1 billion, aligning closely with Ford's anticipated full-year operating loss estimate of $4.5 billion. These figures underscore the financial hurdles Ford is grappling with in the electric vehicle segment. It's important to note that Ford isn't alone in facing these challenges. The slowdown in EV adoption is impacting the entire North American electric vehicle manufacturing and supply chain. Key battery suppliers, such as LG Energy Solution, LGES, and SK On, are also adjusting their expansion plans, citing sluggish demands in the electric vehicle market. Manufacturers and suppliers alike are all recalibrating in response to the current state of the EV market. Despite this adjustment, it's worth noting that Ford is still making strides with the F-150 Lightning. By November of this year, the company had sold over 20,000 electric trucks, marking a 54% increase from last year. This includes their highest monthly sales, with 4,393 trucks sold. These figures, though a fraction of Ford's overall truck sales, signal a growing interest in electric trucks. In the face of these sales achievements, Ford had to make some strategic operational adjustments. The company idled one of their 3 shifts at the Lightning plant in October, impacting approximately 700 workers. This decision came even after the recent addition of a 3rd shift, emphasizing the complex balancing act Ford is navigating in line with the evolving market dynamics. It hints at the need for flexibility in production to match the actual sales pace. But what does all this mean for Ford's future? Are these changes just a detour or a whole new roadmap for the company's journey into electric vehicles? Ford's path in the electric vehicle market is taking a new turn. The Ford Plus plan, revealed at the Capital Markets Day in May, laid out a visionary roadmap for the company's EV transformation. But recent developments have led to Ford's pushing out around $12 billion in EV investments and shrinking battery capacity at upcoming plants, including one in Michigan using CATL technology. Additionally, Ford is postponing the start of production at 2 joint venture battery plants in Kentucky. Despite these adjustments and challenges, such as the UAW strike and rising labor costs, Ford is not losing sight of its financial goals. Ford CFO John Lawler, speaking at the Barclays Automotive and Mobility Conference in New York, highlighted the company's target of achieving an 8% EBIT margin for its EV business by 2026. This target is ambitious, especially when compared to the EBIT margins of Ford's traditional gas-powered business and Ford Pro commercial unit. Ford CEO Jim Farley provided further insights into the company's strategy. In a statement, Farley emphasized the need for a fundamental redesign of their second-generation EV products, distinct from the first-generation models. But will this production cut change how consumers view Ford's commitment to electric vehicles? In terms of consumer perception, the current landscape shows that despite enthusiasm for electric vehicles, practical concerns are tempting the market's growth. Consumers are increasingly aware of the challenges associated with EVs. However, it's also evident that there's a strong interest in electric vehicles. The significant number of reservations for the F-150 Lightning before Ford's production cut demonstrates a clear consumer interest in EVs from established automakers. Ford's decision to align production with actual demand reflects a strategy that is responsive to these consumer concerns. By adjusting their production targets, Ford appears to be prioritizing a more sustainable and customer-focused approach. This could play a critical role in maintaining consumer trust and interest in their EV offerings. Ford's approach suggests a commitment to not only meeting but also understanding and adapting to the evolving needs and expectations of electric vehicle consumers. In the unpredicted EV industry, Ford's move to halve the F-150 Lightning's production marks a crucial turn in the race. The industry's evolution, driven by consumer choice, economic realities, and charging infrastructures, shapes Ford's journey and its response to the electric vehicle challenge. As competitors like GM and Tesla accelerate their EV efforts, Ford's approach could redefine its position in this high-speed contest. Will this strategic shift steer Ford towards a future where it leads in electric innovation, or is it a cautious lane change in the face of industry uncertainties? The answer lies on the road ahead. a route lined with both potential breakthroughs and unforeseen obstacles. Don't miss any turn in this evolving story. Hit that subscribe button, like our video for more automotive insights, and stay tuned for the next episode in the saga of the electric vehicle revolution.